Good afternoon and welcome to BizTech Asian Midday Market Watch. I'm Samantha Voon, and let's start by taking a look at the summary of market actions. So today, Asian stocks saw an uptake as concerns over the looming US recession diminished. We also see the Chinese market sentiments lifted as they see encouraging inflation data. However, despite the day's gains, regional markets are still nursing losses that happened earlier this week. Over in the US, we've seen an improved performance on Wall Street, and that has helped boost the Asian markets thanks to the US jobless claims data that surpassed expectations, and that lifted fears about the US labor market condition. Over in China, the Chinese market is still underperforming compared to their Asian counterparts. The Shanghai Composite Index is up 0.02%, modest, and the index was down roughly 1.1% for the week, marking its third consecutive week of losses. Nonetheless, recent inflation figures brought some optimism, right? So we have the consumer price index, the CPI, rose more than expected. The producer price index, the PPI, showed a slower than expected decline, hinting that the PBOC's recent interest rate cuts might be having an impact. So despite these positive signs, uncertainty remains as the Chinese markets have been weighed down by a series of disappointing economic indicators, keeping the main index near its 6-month low. Over in Japan, the Nikkei 225 is down 0.73%, while the index managed to recover significant portions of its earlier losses. So although the index is still down about 3% for the week, it managed to recover a big chunk of it. So the rebound was supported by the BOJ's officials' effort to soften the impact of the central bank's sudden and expected hawkish stance from the previous week. On top of that, we also had the bargain hunting of major tech stocks, as well as the strong earning reports, such as the 1.7% rise in the Tokyo Electron shares. Over in the broader Asian markets, we have other tech-heavy markets in Asia, such as the South Korean Kospi that is up 0.83%, and the Hong Kong Hang Seng that's up 1.20%, reflecting similar recoveries in the US markets. In Australia, the ASX 200 is up 0.98%, and in India, the Nifty 50 is up 0.81%. So that's all I have for today's market updates. To give insights, we have Kelvin Wong, senior market analyst at Oanda in Singapore. Kelvin, welcome to the show.
Thank you, Samantha, and happy Friday.
Happy Friday. All right, it's been a really exciting week. We've just been talking about this off screen just now, but let's start with the China's inflation data. Can you tell us more about that?
Sure, precisely. So if you look at the China inflation data, the headline number indeed improved as compared to the previous month of June. The CPI rate for the month of July actually increased at a much faster pace of 0.3% year on year. Pardon me, that's 0.5% year on year versus 0.3% year on year in the previous month of June. But however, if you strip out those volatile items like energy and food price, the core inflation rate in China was not actually that fantastic. So it actually slipped slightly lower to 0.4% year on year in July from 0.6% year on year in June. So if you dive deeper into this core inflation trend in China, the fears of deflationary pressure has not really been totally eradicated in the Chinese economy. So that actually explained to us also the lackluster, we call it performance on the intraday basis on the China benchmark stock indices where they're still kind of being hovering between positive and negative territory right now by some of the we call it benchmark stock indices in China. And what we could see over here is that market participants, the next step for market participants to watch out for will be much more potential, we call it forceful stimulus plan coming out from the top policymakers. Because so far right now, yes, we do see some rhetoric from them in terms of their press release stating that the China policymakers wanting to actually embark on much more stimulus plan that focus more on consumer spending. But that's more about from the rhetoric side of things. But market participants will want to see more actual actions coming from this aspect of the policy making.
Okay, so how about the global markets? Let's move to the global markets. What is the current state after the risk-off we saw on Monday?
Yes, precisely. So if you look at the current, firstly, let's talk about what causes this, we call it dramatic global synchronized risk-off scenario, where we see across the board of dumping of risk assets like stocks, and also unwinding of those carry trades, especially that's related to using yen as a funding currency to actually invest in more higher risk assets like global equities. So I would say that initially it was started in early part of, or say put it away that somewhere around the third week of July this year, where we start to see number one, couple of release of those mega cap technology stock earnings reports with the likes of Amazon, Alphabet, which is Google, do not actually meet as expected in terms of their earlier rosy earnings growth expectation. So that actually caused market to actually question the growth prospect of this particular mega cap technology stocks. And bear in mind, if you look at the last 1 year or so, or even the start of year to date, there's a lot of over concentrated optimistic, we call it bullish position being centered around these stocks, driven by the fact of the AI productivity growth. And market participants start to question whether AI right now, is it a real revenue generator going forward, or is right now it's still a cost center in the very near term. So that causes a unwinding of this, we call it over concentration, a bullish position in this mega cap technology stocks, especially Nvidia, which is fell into corrective territory. And what actually magnified it further over here is due to some of the much more larger speculative players like hedge funds using leverage play to actually get into this bullish position. And given the fact that the yen is also one of them, intercorrelated play over here together with the low VIX environment, and as long as one of the domino four actually create a negative amplified impact across the market. Okay, so that actually explain this potential drop. I would say that it actually lead to a point of indiscriminating risk of behavior, where some of the sectors of the equity sectors or even geographic region that has better fundamentals, less extreme valuation, also got hit as well. So if you look at since the start of Tuesday, we start to see this better valuation, we call it or kind of a much more less richly valued play in the from a geographical standpoint, the sector standpoints like the financials, the cyclical sector of the US, we call it stock market, and as well as the rest of the world start to see some form of recovery, and the recovery has taken shape into yesterday's session as well as we discussed earlier. So right now what we could see over here is going forward, if there's a big if over here right now, if the US economy managed to escape from a recessionary scenario, that means i.e. the bull steepening of the US Treasury yield curve will be still intact, and its positiveness can be able to spill over to the laggards, which is those cyclical stocks that are heavily concentrated in the Dow Jones Industrial Average, those small caps stocks as well, which is in the Russell 2000, will be able to play that decent catch up against those mega cap stocks that are heavily kind of a richly overvalued at this juncture. Potentially, that means, i.e., the Nasdaq 100, the S&P 500 will take a back seat instead, whilst those the Dow Jones Industrial and the Russell 2000 right now will take a front seat. But this is provided that we have more data coming out from the US job market, that is not clearly pointing towards a recessionary-like scenario in the US. So right now, I think to my own opinion, market participants will be heavily watching any signs of this state of the job data in the US. That means every little metrics they'll be scrutinizing it. Like last week, yesterday's weekly initial jobless claim, and the next one will be the ISM manufacturing and the ISM services employment component data of it. And going forward will be the all-important non-farm payroll data, which is out next month as well.
So I suppose we have to take keep looking at these data to know what's the next move that will happen.
Yes, precisely, yes.
Okay, lovely. So to close off, do you have anything that you want to close this session with?
Sure. So if you look at today's session after, during the European session and the Asia session be pretty much quiet. So market participants will start to focus more on next week instead. So next week we do have the all-important CPI data out from the US. So more or less this particular trend of deceleration, we call it inflationary trend in US from a core inflation perspective, more likely to be pretty much intact because market participant is still looking for a rather continuation of a deceleration trend of inflation number US, where the expectation for the core inflation rate for July to come down slightly lower by 1 basis point to 0.2% from 3.3% year on year in June. So if this more or less come within market expectation, the Fed will be having much more data to actually kickstart their interest rate cut cycle in the September meeting. And the next on the list will be on Thursday. So we have the US CPI data out on Wednesday. So on Thursday, we do have the key economic data out from China that will actually also determine whether the Chinese economy is slipping into a state of a deflationary spiral or not. So we do have retail sales number, which is pretty much will be scrutinized because retail sales number in China has been lackluster in the last 3 to 4 months. So now market expectation because due to the low base figure from last year, market do expect it to have a slight recovery to 2.6% year on year for the month of July from 2% year-on-year growth for the month of June. So something to pay attention to. And also, I believe that do also keep a close watch on the China side of the story, whether will China top policymakers start to actually announce much more stimulus plan that's much more centered on consumer spending or to boost consumer confidence. And given the fact that right now, I do think that this is a window of opportunity for them to do it. Why? Because the dollar has already started to weaken against the Chinese yuan to a low as 8-month low in the last 1 to 2 weeks or so. So if the China top policymaker were to use this opportunity to announce much more forceful stimulus plan to boost consumer spending or indirectly also consumer confidence, that could actually prevent lesser capital outflow from China.
Well, thank you so much, Kelvin. Those were really important insights that you gave there.
My pleasure.
So this has been BizTech Asian Midday Market Watch. I'm Samantha Voon, and be sure to keep informed with the latest market updates weekdays at 1 p.m. This video and podcast will be on our website, www.biztech.asia, and our social media platforms. It will also be on our syndication partners' TV stations, radio stations, and website. Remember to like and subscribe. Thanks for tuning in.